Most of us by now are getting used to a barrage of monthly subscription costs adding up on our bank statements. My suggestion to you is consider treating stock market volatility as the regular subscription price you pay for investing in the stock market for long-term returns. As you've probably heard, higher returns mean higher volatility. For those who want higher returns, they'll need to treat market swings as an integral feature of investing. It's just the way it works. Morgan Housel does a great job of laying this out in his excellent 2019 article, Fees versus Fines. He says it like this: but if you view volatility as a fee, things look different. Disneyland tickets cost $100, but you get an awesome day with your kids you'll never forget. Last year, more than 18 million people thought that fee was worth paying. Few felt the $100 paid was a punishment or a fine. The worthwhile trade-off of fees is obvious when it's clear you're paying one. Same with investing, where volatility is almost always a fee, not a fine. Returns are never free. They demand you pay a price, like any other product. And since market returns can be not just great, but sensational over time, the fee is high. Declines, crashes, panics, manias, recessions, depressions. You're not forced to pay this fee. Just like you're not forced to go to Disneyland. JP Morgan has an excellent chart that shows annual returns and annual declines of the S&P 500 since 1980, this particular chart going to 2021. There are a ton of investing lessons to draw from this. Notice how often big declines happen the last 40 plus years during a year where the market ended the year higher. As the chart shows, even though the market averaged an intra-year decline of 14.3%, the market only ended lower in 10 out of the 41 years. Surprising to some, annual returns were higher 75% of the time during this period. Here's another one. Imagine selling if the market went down 10% or more during a year, fearing that the market might enter a long-term bear market. If you sold in those years where that occurred, you would have missed out on the calendar year returns of, get ready, 26% in 1980, 15% in 82, 31% in 97, 27% in 98, 20% in 99, 26% in 03, 23% in 09, 13% in 10, 13% in 12, 10% in 16, and 16% in 20. That is nearly half the time. 11 out of the 23 times where the market declined 10% or more during the year, it was up 10% or more by the end of that very same year. Furthermore, big dips of 20% or more don't always mean further multi-year declines. While the year of the infamous one-day market crash in 1987 suffered a drawdown of 34%, the market ended the year 2% higher. Sure, these kinds of intra-year declines can make for bad years like 01, 02, and 08 demonstrate, yet massive intra-year declines can also end well like in 09 and as recently as 2020. What happens in the past is not predictive of what might happen in the future, but this 4-decade history of stocks in the largest U.S. companies, though not exhaustive, reveal that volatility, like returns, are normal. Say it with me, volatility is normal. Remember those 3 words next time stocks plunge. Volatility is the subscription price of stock market investing. If you cancel your subscription due to volatility and bail on the S&P 500, you will likely say goodbye to high investment returns. And by canceling too early, you may find that not too far into the future, you might have gained back or exceeded what you had originally invested. Plan and budget for the ups and downs of your investments as the cost of long-term returns. Yes, the swings during the year printed on your monthly statement are way bigger than a $9.99 monthly budget item, but the percentage returns of consistent long-term investing have rewarded S&P 500 participants nicely. Hey, if you like our content and you've enjoyed our channel, watch a bunch of the other videos. Send it to a friend, like, subscribe, share our content. We'd appreciate it.